Welcome, friends. It's time for another tokenomics, and we've got, as always, some very dramatic news to talk about this week. So this week, we've got Anton Bachman, principal at Play Ventures.
Hello, hello.
Special guest, Kenrick, very Finnish last name I will not try and pronounce, a general partner at Play Future Fund.
Hey,
Kenrick, what is your last name?
It's Drijkoningen, and it's Dutch, but close enough.
Dutch. My fat American tongue can't even come close to saying it right. And we've got myself, Ethan Levy, executive producer of Legendary Heroes Unchained at Network. Today we're going to talk about and explain the story I'm sure you've all read plenty about, the dramatic collapse of the Terra ecosystem, all that and more on today's Tokenomics. Excited about NFTs in the metaverse? Ready to be part of the future of gaming? Recur is looking for talented producers, product managers, game designers, economy designers, and engineers. Recur is building branded NFT collectibles and games with top IP, including college sports, Paramount, Star Trek, Nickelodeon, Sanrio, and more, using its best-in-the-industry technology platform. Recur's platform streamlines the NFT collecting experience. No crypto or third-party wallets required. Simply buy an NFT with your credit card or Apple Pay. And Recur's robust gamification system creates infinite collecting and gameplay possibilities from which to make compelling play-and-earn experiences. Recur is backed by some of the biggest names in crypto and NFTs, including billionaire Stephen Cohn, Gary Vee, and Gemini, among others. Join us now and get ready to ride a rocket ship. Let's fucking go. All right, let's start. Kenrick, since you're a new voice on the podcast, could you begin by introducing yourself and telling us a little bit about your background?
Sure. Thanks for having me, Ethan. I'm Kenrick. As I mentioned, I'm Dutch originally, but been in Singapore for the past 11 years. Used to work at a number of startups here, primarily on the digital marketing side, including the UA in the gaming space. I used to work with Kenrick, one of the founding partners of Play, at his gaming startup back in the day, Nonstop Games, before we got acquired by King, and then later started a small crypto venture fund in Singapore that was called Lunex. As part of another VC here. We invested in crypto financial infrastructure, so wallets, KYC, AML, custodians, exchanges, DeFi protocols, and Terra was one of our investments at the time as well. So we set that up in 2017, 2018, and last year rejoined Henrik and the partners and Anton at Play to raise the new fund that we just launched at the end of last year, which is the Play Future Fund. So that's the fund that Anton and myself are running, investing in all things Web3 crypto gaming, both the studios as well as the infrastructure play. So we've done a number of studios, we've done some guilds, we've done borrowing and lending protocols, NFT marketplaces, across the whole stack basically. So that's what we're currently doing.
Got it. Well, thanks for coming on. And as kind of an early investor in Terra, I thought you'd be a perfect voice to help us explain what's happened and how to think about it. So let me set the stage. If you're listening, you've likely seen the headlines about the collapse of token value of Luna and UST, the two primary tokens in the Terra ecosystem. From their website, Terra is a public blockchain protocol deploying a suite of algorithmic, decentralized stablecoins which underpin a thriving ecosystem that brings DeFi to the masses. So if I understand it correctly, Terra was an L1 chain, and it had two tokens, Luna and UST. UST is marketed as a stable coin, and it was an algorithmic stable coin, which meant they weren't saying for every UST we issue, there's $1 USD worth of gold in a bank vault, and if you redeem your UST, you can always get that dollar back. It wasn't backed by fiat assets at any point. It was backed by an algorithm, and the claim was that UST would stay pegged to $1, and Luna would be a store of value, and they could sell, if I understand correctly, when to keep that price pegged, they could always sell Luna in order to increase, buy and increase the price of UST, or they could use their holdings from the Luna Guard Foundation, which owned billions in Bitcoin, to prop up that price. So the idea was that they would keep UST pegged using algorithms and the backing of other tokens. And then another important part of this ecosystem was the Anchor protocol, which was a staking protocol, which I believe was providing 20% return on staked. Do you guys know, was it staked UST, staked Luna, or both? I actually forgot
it's
to
UST,
write that down.
But maybe I'll run through the background of Terra, then gives you a clearer picture of how we kind of arrived at this point. So basically, when I started in 2018, the original idea and vision was very much to power real-world payments or e-commerce payments. So they were looking to do integrations with Carousel, which is an online marketplace here in Singapore. They had a Chai payments app in Korea. And so the idea was really to facilitate the transfer of value with fiat, like on their network. So somebody makes a payment and it transfers and gets paid. So the biggest stablecoin in the beginning was actually KRT, the Korean won. And later they had a couple of other ones, MNT, and UST came later. But basically the way that it works is very simple. The dollar that is UST is basically backed by the equity value of the Luna network. So you could always redeem, up until very recently, you could always redeem one UST for $1. And the way that mechanism works is basically you redeem one UST and the protocol mints an additional Luna or number of Lunas and sells that into the market towards the value of $1. So I think at the end, the total outstanding supply of UST was 19 billion US dollars, and the total network value, or the market cap, if you like, of Luna was $40 billion. So you would think, like if you just look at it that way, that UST was backed by the network value, but obviously market cap is not the same as, like, you can't sell $40 billion on that market and then have, all those dollars. It doesn't work like that. There's slippage. There's just not enough demand to prop that up. So when it started off, it made sense. They used this seigniorage basically to give discounts to the merchants, or to the end consumer purchasing stuff from the merchants. And seigniorage is basically the same way that our fiat system works, in that money is basically created out of thin air, but then in the fiat system there's demand for that money through paying taxes. You need to pay your oil bills in US dollars. The government has a monopoly on violence. Basically, you have to use this coin in our payment system. But for UST, that's obviously not the case. So I think over time, things got a little bit out of hand, because you can do this in smaller quantities and doses. So if you have a $40 billion market cap and you issue 1, 2, 3, 4, 5 billion of UST on top of that, the market could absorb that, right? Like if you sell $1 billion into a 40 billion market cap, and I don't know what the exact ratio is, what works or what stops working at some point, but the point is that humans being humans obviously get a little bit too greedy, too far ahead of themselves, and start to issue too much money, and then it becomes an unsustainable value proposition, basically. So that's what happened over time. And basically Anchor was just used to lock UST in the protocol. Very successful until people started withdrawing it, and this is what happened basically.
Right.
And just maybe adding to that, maybe a quick taxonomy on the main models for stablecoins. So we have the algorithmic one, as Kenrick was describing. So there is no collateral behind it. It's mainly based on incentives keeping it together. And then you have currencies like Tether or USDT that are fiat backed and have, so for each USDT there's a US dollar somewhere in a bank account, and then a bit a bit in the same league. You have also the crypto-backed stablecoins. So Maker and DAI being an example where people over-collateralize. They lock in a certain amount of Ether, for example, and then they receive a certain amount of stablecoin, and then that over-collateralization aims to keep the price steady. And then the third one here would be...
And one other way to think about this is they all have different risk trade-offs. So the risk trade-off for UST was pretty clear now. The risk trade-off for USDT is that it's being run by an offshore organization, Tether, which is semi-audited, and we think there's probably some collateral there, but we don't know exactly what it is or how much it is.
Right.
The trade-off for USDC is very much that the U.S. government could freeze your money because it's controlled by Circle Financial, which sits in the U.S., so you have regulatory risk on that one. And then DAI, basically, which is backed by Ether or other assets in that protocol. You have smart contract and protocol risk from the Maker protocol. So they're all different and they have different risk parameters and trade-offs. I think USDC is the safest, followed by USDT. But yeah, they're all slightly different. Yeah.
So when you originally invested in Terra, this wasn't a project or a protocol that was generated specifically for the facilitation of game economies. That's something that came as one of the uses of the network over time. Originally, it sounds like facilitating the buying and selling of goods through the generation of these stable digital currencies. That was the purpose of Terra originally.
Yeah, exactly. That's why they started with the Chai payment app in Korea. They made a push for like online platforms to use these payment rails. But I think what happened over time is that it just became a lot easier to offer stablecoins within DeFi because that's growing a lot faster. You don't need to do a lot of work to integrate your solution with real-world businesses. You can just basically print more money, if you like, and use it in these anchor protocols or other DeFi kind of solutions. And I think that's what got the better of them in the end. The idea itself could potentially still have worked, but again, I think it just got too greedy. Yeah.
All right, so 30 days ago, the price of Luna was $81.45. Now it's less than 0.2 of a cent. And UST, which was $1 30 days ago at the start of the recording, was 8.4 cents, essentially. And I know that it's not completely known yet what happened or kind of what caused the attack, but like at a high level, the best I can understand it is that UST, the stablecoin, became unpegged from $1, and so somebody did something that like knocked it off $1, and then people panicked and started selling off both Luna and UST, and panic caused more panic, and it got into a death spiral, and along the way, the Luna Foundation Guard sold or swapped billions of dollars worth of Bitcoin to try and keep that UST price pegged at $1, and that effort failed. And they've basically spent or gotten rid of, it was like billions of dollars of Bitcoin. Is that an accurate description? Is like bank run the right metaphor with which to think about this? How would you guys explain the collapse in value of these two tokens?
Yeah, I think so. I think it was a combination of almost like a perfect storm that came together. It was not a single issue. There were a number of different ones. Obviously, people kind of knew that there was always a risk. And without commenting whether this was specifically an attack or just an unfortunate kind of combining of circumstances, we don't know. We don't know.
It doesn't matter for the outcome, right?
Yeah, for the outcome, it doesn't really matter. But it happened when there's a big DeFi protocol called Curve on which stablecoin swaps happen, and there's a lot of liquidity on there. And at some point last week, somebody removed a whole bunch of liquidity from the pool where you can swap your UST. That caused the pack to go off a little bit. With that, you get more people noticing this. You get a few more people trying to exit it. With that, you get Luna printing, basically, right? Because that's the redemption mechanism, which then tanks the Luna price. And this is all in a macro environment where crypto prices are already going down. So the collateral that's part of the Luna Foundation, which was Bitcoin, Avalanche, a couple of other tokens, was
BNB,
also going
I
down.
think.
Was also going down at the same point. And you get to a point where there's enough people who lose trust, and because of the mechanism, and I think they made one crucial mistake actually. The UST was going off peg already, and what they should have done is kind of limit the redemption, because I think there was a cap on total UST redemption per day, and instead of saying we're going to limit this and slow the redemption over time, they doubled down on it and said like we need to get back to the peg faster, which basically hyperinflated Luna. So many tokens were printed that the order books entirely disappeared, so you couldn't sell Luna anymore because there was no bid like on FTX. The entire market just went to the smallest tick, which is like 0.001 cent or whatever, and that's where all the asks were sitting. But you cannot place a bid at $0, right? Like, there's no mechanism for that, so that you can't sell the Luna anymore. Peg breaks, everything breaks, hyperinflates, and that's kind of what
essentially a bit similar to a bank run where kind of customers lose faith that the bank is going to remain solvent, and then everybody kind of speeds up to withdraw their assets from the bank at the same time, which then eventually causes the collapse. Now, I read a couple of working theories on kind of how this one was set up. I think some of them were aligned around this idea of this attacker that reacted to Luna's or the foundation's intends to purchase more Bitcoin, as they announced that in March, and then this attacker went on to borrow a large quantity of Bitcoin that they then started selling against Luna's buy orders. Then later on, while this kind of so they were switching liquidity from one of the curve pools to another, and that's when they kind of saw the window of opportunity of attacking it when it was vulnerable, and that was one of the kind of moments where the death spiral then started, and then the rest basically was panicking, as Kenrick mentioned.
Yeah, I think, the thing I want to say is, like, my hearts go out to the people who lost their life savings. There are stories, and I don't know if they're confirmed or not, of people losing their life savings, of people committing suicide, and this causing, the majority, or many of the losses are just paper losses, right? Or losses among investor class, but part of the danger, potential financial danger of crypto is that it's extremely volatile, it's extremely risky, and I think that a lot of people are not used to thinking about money or even stocks in this way. Like, I think especially if you're listening to this podcast, you're probably in a country with fairly stable currency value, and you don't think about that currency is propped up only by faith, that like money is a technology that humans use to aid in commerce, but it's not a real thing, and cryptocurrency is no different. And if anything, it's so early and experimental. Like this sort of stuff keeps happening, and it'll happen for a long time. And this is not financial advice, but like when I make an investment, generally I'm investing, like when I bought into the initial Iron Source listing after it's SPAC, right? My brain goes, well, this is a couple $100, and in 30 years it might be worth nothing, and it might be worth a lot more. And I think it's more likely than not that it'll be worth a lot more over time. And so that's why I'm willing to make this bet, and I'm willing to lose this money completely. And I think a lot of the hype and discourse, especially around cryptocurrency, like completely ignores these ideas of the volatility and the riskiness of the bets, and that you should never invest money that you're not willing to completely lose due to the riskiness of it. I think that, both between governments providing currency stability and then business stability in times of crisis, people are not used to the true implications of capitalism, that it's almost evolutionary and that things are bound to fail. So I guess my point is I really empathize for anybody who experienced real and painful losses as a result of this unwinding. And, as always, do your own research, make the choices that are right for you based on your personal risk profile. So, given that, in hindsight, what are the... It seems like there were some obvious mistakes along the way, or there were some mistakes along the way, right? Not spotting that this collapse was happening and taking more preventative measures. Do you feel like is the decentralization of Terra or similar networks, does that fight against the ability to take action in time of crisis?
I think with Terra, it's a very specific kind of example in the way that it was designed, with this kind of dual token system. Most other networks do not have this. Bitcoin is a hard asset. ETH is a hard asset. The protocol itself doesn't have this redemption or issuing mechanism of two assets. So I think this was very specific to Terra, unfortunately, yes.
Got it.
I think something they could have, or something that I think I felt they got a lot of criticism for after these events started unfolding and there started being hysteria, is that some of these accounts on Twitter, like the founder as well as the foundation guard, went relatively silent. Weren't providing too many updates on kind of where things are going in the war room, and taking preventive measures, what's happening with the LFG, and then it was just announced or clear a couple of days later that the LFG reserve was empty, or they were all being used already,
right.
And was led to obviously a lot of just like free speculation about not knowing what's going on within the core team. Behind the project.
Got it. So more transparency could have helped with the faith aspect of it, and along with what you said previously about slowing down.
Probably at least as part of the damage control kind of post as well, because now the founder is again participating in the discourse, but is not in a very good light, and not getting too much love at the moment. Some even suggesting that
I guess my takeaway is I guess my takeaway is still, if you put humans in charge of these systems, at one point or another, they're going to mess it up. You want to have very robust systems. I see it really as an analogy to our kind of fiat system, which is also not sustainable. But again, because governments are behind it, we can draw this out over much longer periods of time. But it's by no means different. And I think this is some of the arguments that a lot of the crypto bros, as you guys love to refer to them, are making, is that you need a monetary system that's actually backed by a hard asset, or by an asset that's not being controlled by humans, like the US dollar or UST was. But whether that's on Bitcoin or Ethereum or whatever, it just has a fixed supply, and that's transparent, and that's issued by the protocol. And there's no, ambiguity difficult word for me. You know what I mean?
Ambiguity.
Ambiguity.
Yeah, that one. See, now you go wrong as well. In the issuance of that, it's very fixed. Like we know what's there.
Mm-hmm.
Take humans out of the equation. I think built more robust systems over time. And again, it was human error here at the end, and not kind of the protocol worked flawlessly as designed. It just had a number of design flaws. Yeah.
Got it. So, Kenrick, you were an early investor in Terra. What originally drew you to this project and this protocol?
Yeah, I think at the time in 2018, there was not a lot of real world adoption of crypto itself, right? There was, we just had like the ICO phase and kind of real early stuff, but people weren't really using it in the real world. And this was one of the kind of pitch propositions of Terra, is that they were going to integrate with e-commerce players, and they're going to make online payments easier and better, and you get discounts for users and stuff like that. So I think that's a valuable kind of goal that they had in mind. And a lot of stuff was experimental at the time, and their model worked. But again, we actually exited this position early 2021 when we saw kind of
Oh, wow.
USD issuance going slightly exponential, and it just diverged from the original thesis that the company had, or the protocol had. And I think that's one of the interesting parts of tokens or protocols, is that you can change your mind over time. If it diverges from what it originally set out to do, you can actually sell your investment.
Right. If you had a pure stock investment and there was no public market and no purchasers, you would have been probably wiped out. I mean, seems like that's how history's going in terms of this investment. But you, if I'm understanding right, as an investor, you said, hey, I invested in this with a specific use case and theory and risk profile, and the behaviors they're taking are getting too risky for me. They're like leaning into what seems like a flaw in the system, so I'm going to take my wins now, right? And even if you didn't take your wins at the peak, right, at 120 or whatever it was, you probably made a really healthy profit and removed that risk, right, for you guys personally.
Yeah, and of course, that's a little bit sour in hindsight to say. And for the past year, I felt pretty much like an idiot because the price still went up 10x after we sold.
Right.
But the point I'm trying to make here is that the liquidity in some of these protocols and tokens just makes for very interesting markets, because you have higher investor turnover. Mm-hmm. You can change your view over time as you see fit, which is very different, right, from traditional venture funds where you're just locked up in your equity for 10 years or until there's some kind of exit. You can be much more dynamic with token projects.
Yeah. You know, I have so on the game I'm working on right now, one of the many conversations we're having right now is about staking. And my personal opinion, when I look at it, is that within the realm of specifically of game economies, staking to me feels like pure financial engineering or pure manipulation, right? Like when someone stakes tokens, they say, I'm going to not spend my tokens for a set period of time, and you then give them more tokens. And this provides utility in a world where there isn't a game yet, right? Or there's nothing else to do. What can you do with your tokens? Well, you can lock them away to artificially constrain the supply to increase the value of them. And so my personal theory is that in terms of game utility, we don't require this form of staking because you should launch a token alongside a game that it can clearly be used in, and that provides the utility for it. And if people are acquiring the token, it should be for in-game use or to sell to people who have true in-game use. So, I kind of view staking as pretty risky and kind of financial engineering or covering up for lack of product and use case. Do you guys, what's your response to that position? Do you feel like that's warranted? Was staking a critical flaw here? Is staking, kind of what are your opinions on staking? And do you think that
I don't think you described staking. They just took the word staking and applied it to just locking up your tokens. The idea of staking is that you also put something at risk. Right. So that's why it's proof of stake, right? So if you are a malicious actor or you don't validate the chain, you might get slashed on your stake. Mm-hmm. So you're actually putting economic value up to secure the network, and if you don't do a good job, you get slashed and you lose some of that value. Mm-hmm. But I think that's the way that some others have implemented it, is just, you just lock up your tokens and we give you a yield for that. That doesn't make a lot of sense.
Mm-hmm. Yeah, and that's I think quite typical what we see in the gaming projects for quite some time, is that, and as Kenrick mentioned, usually talked about as staking, but it's more as a lockup some kind of a lockup program promising more future rewards, and usually tied to, if you lock them up now, you'll get bigger rewards in the future. Mm-hmm. And that's similar to, for example, how Step-In currently works, which is this walk to earn product on Solana currently that has had a lot of traction, and naturally this kind of staking lends itself to quite good user growth, because a lot of these users come in for the promise of future returns.
Right.
And then you're just kind of prolonging that process by promising better and better future returns for the longer time you lock up your tokens and then up. But obviously, if someone starts cashing out, then it's and the user growth starts stagnating, then it starts being an issue also for these products. So it's almost like if a product implements this kind of a token reward program or system for the users. And that kind of exponential it kickstarts the exponential user growth because people are in it for kind of the rewards. Then that's almost the time you have to create valuable sinks in the product if you don't have those, because all of these sinks of locking up your tokens yet again for bigger rewards they wouldn't be considered as real sinks, because they aren't really providing any value. There's no value that the user is paying for. Now deviating a bit from the original question, but that's mainly probably the kind of program you're referring to also.
Yeah. So two interesting points there. One is that the way I'm even talking about staking rewards, and the way I see it a lot in public is not is not true staking as it's intended, where staking is part of running the network. You put up collateral for the right to run the network and validate transactions, and if you fail to do your duty properly, you're penalized, right? Mostly it's just presented to users as a lockup protocol with rewards, and that it has a valid use case for marketing, right? You can look at it as a marketing cost to kickstart your growth, but it can be a double-edged sword in that way. Something that's really interesting, so like Com2UX, Com2Us is a developer that I have a lot of respect for. They make games and similar to the ones I've done, and they've done a really great job with a lot of mid-core RPGs. They just released Chromatic Souls AFK Arena. I have it on my phone right now. I've been playing it. The art's beautiful. And I know vaguely that it's tied in, that it is a blockchain game, although because I'm playing on the phone, I haven't... Everything about it being part of the blockchain, or having blockchain is walled off, and I haven't yet discovered it outside of the app. But I know that they're not alone in being a developer who was building on this Terra ecosystem. And so, like, what happens now? What happens if you're one of these developers in Play's portfolio, and they were building on some chain, and the chain basically collapses? What options do they have now?
Yeah, I think in general, we always, or the deals that we look for, or companies we're interested in, like we always say, we want them to build on credibly neutral layer ones. So robust layer ones that we think have proven themselves over time and are robust to semi-robust. So Ethereum, obviously, some of the ones around that, Polygon, Avalanche is coming into that, Solana to a degree. So I think that's kind of we're looking for the main chains to, in terms of companies that we invest in. When it comes to Terra more specifically, and the companies building who have built on that, I guess they have the option to migrate to Cosmos, because that's the same underlying technology that they can actually go on. But I think everybody's kind of waiting for it, how it's playing out, because we don't know yet. There's all kinds of proposals. Should we fork the chain? Should we restart it? It's actually up and running now. I believe that the delegation is kind of frozen, so you can't change the validators at the moment, but the chain is up and running. So are we going to have a new start of this chain? Is going to be a different chain? I think people are kind of waiting and seeing what's going to happen. But then, I think they'll have to migrate. And over time, people will, I think, converge on just the proven and solid layer ones. Yeah.
And clearly, I think what we've seen, and also from our chats with the alternative layer ones and layer twos, is that sort of now, obviously, they're seeing an opportunity now to be quick in onboarding. I think a lot of these are trying to poach developers that previously were building on Terra or were looking to build on Terra to work on their chains as well.
I mean, just if you compare the feature depth and art of Chromatic Souls to a lot of what's currently playable in the general blockchain ecosystem, most games aren't even playable. Like, if I ran one of those networks, I would love to have this game at such a high quality on it, and I'd be trying to figure out how to basically Vampire Strike and get them over to my network. So when developers come to you guys, I know that Play is an early stage fund. Have developers generally chosen a chain for their project or projects? Is that something you help them with? Like, how do you... It seems like a really critical choice for a game company to make, and actually quite frightening if you're thinking about it, like, literally this week, when you're seeing the possibilities of what can happen. So how, what stage of the decision making are game companies coming to you with, and how do you help them with that decision?
So I think at varying levels, some already have an idea of what they're going to build on. Some haven't really given it much thought. Obviously, if you're coming with a free-to-play background and a limited understanding in crypto, but you know how to make games, then it's probably not as straightforward as a lot of these kind of value propositions look very similar. I think, as Kenrick said, we don't have like a clear favorite that, hey, you should be building on this one. I think it comes a lot down to the intricacies of the companies themselves and the games that they're looking to build. And at the end of the day, I think there's only a couple of key things you want to be maximizing for right now, and that's obviously that it's something that is as proven to be as secure as possible. Ethereum is likely going to be difficult due to the current issues in scalability, but looking at some of the adjacent ones, the other ones we mentioned, obviously Polygon, as it's EVM compatible, Avalanche being a newcomer, Solana also being one, but again a bit more secluded due to running on a different language. But I think we need to also operate with the assumption that the end user probably is not going to care too much
Right.
In the next few years, when hopefully a lot of the complexity will be abstracted through better wallet design, hosted wallets for people who really don't care about kind of self-custody and managing their own wallet, kind of obfuscating that in the background and having these games feel like any other free-to-play game, basically, with the same kind of frictionless design as you would experience in anything else right now. But obviously, it takes a bit of time from very, very different companies to get to that point. So currently, security definitely being one that is, and it's something that's not going to shut down, that it's going to keep up running, similarly to how you wouldn't want AWS to immediately just shut down.
Yeah.
And then would have to think about migrating somewhere else. Now, obviously, some of these organizations and foundations behind these solutions are starting to get quite big. Not only from a support perspective, not only from personnel support perspective in terms of integration, but also from a financial standpoint. And I think it's also now more about kind of where do you find that you'll have a mutually beneficial partnership, that you'll get both engineering support, biz dev support. Is there funding that could be leveraged from some of these organizations? And not so much maybe about those tinier details. And then it's a talent question as well. So if we're working with a team that already has in-house Rust talent, then probably the low threshold solution there is to go for Solana, as it's based on Rust. But if it's a team that doesn't have Rust developer talent, and even if they don't, obviously most don't have Solidity developer talent, I think what we've seen in our portfolio is that instead of trying to go out there and recruit those really expensive, experienced Solidity developers, because they're either retired from their Ethereum gains, or then they're just have very, very high salaries, because probably an experienced Solidity developer is probably one of the most hot commodities on the planet right now. So what we've seen is having backend developers that have an interest in kind of getting around the ropes of Solidity, because at the end of the day, the contracts that these studios need for their NFTs and the tokens in the game aren't too complex, and we usually seen the teams trying to build that knowledge in-house, and then if they build on Polygon, for example, they get to piggyback on everything that is being developed on Ethereum, due to them being compatible with each other. And obviously there's still a lot of R&D focused on Ethereum, lots of organizations focused on grant programs for developing tools for Ethereum development, different kind of developer frameworks for that. So I think that's also kind of a part of the whole composability aspect, that it's an easier time to deploy something on Polygon when it's been developed on Ethereum, but if we're looking to have those additions on Solana as well, then it's probably a longer way to go in that sense. So no kind of clear question, but I think what we try to do with the developers, we try to, now without this being too much of a sales pitch, trying to kind of highlight the questions you want to be asking yourself before making these choices. But luckily you can go quite far into game development before actually having to choose these things. Or dependent on kind of what level of on-chain elements you want to have in the game.
Yeah, that's an interesting point about the experience level on the team. I liken this period of time very frequently to the explosion of Facebook games, and at the time, it was a giant talent war for Flash developers and people who were experienced in AS3, and there were so few of them, and recruiting them seemed impossible, and salaries were super high. And at Electronic Arts, I remember we actually had just as much luck taking experienced, knowledgeable developers who were interested in learning ActionScript 3. It wasn't painless, but it wasn't that hard. And it was actually a lot simpler than trying to fight over the same 4 people whose experience in game development was using Flash to build slot machine games it was a very weird time. And so from a talent war perspective, I feel like find someone who can code and is interested in learning and work with them to learn the new thing, and don't fight over, as you said, the same small pool of people who are either rich or extremely expensive.
Find someone who looks at Solidity like they look at C++.
Yeah. What do you think this incident impacts the future of stablecoins? I mean, if anything, a stablecoin, as far as I can tell, it being called a stablecoin, that's just a marketing spin, right? It's just intention. There's nothing that can magically force a token to stay exactly on the value of a US dollar. Does this shake your, as investors, how do you think about the future of stablecoins? Like, is it going to be a thing? Are we going to witness the collapse of more of these stablecoins in the future, or does it serve a really critical role in the blockchain ecosystem?
I think, unfortunately, it's probably given a lot of ammo to the regulators to step in, and to step in maybe a little bit early when the technology is still so nascent. Obviously, they've been eyeing this industry for a long time, right? Because they were experimenting with monetary assets and potentially even assets that are a threat to the kind of national banking system of several nations. I mean, Bitcoin is being adopted as legal tender in 3 countries now. There's more to come probably. So, but yeah, this obviously invites regulation, and I don't think that's bad necessarily if it's done in a thoughtful way. Because like if you look at USDC, that's pretty much a regulated stablecoin out of the US that is one-to-one backed with $1 in the bank. So that should just be $1 straight up. As again, except for the U.S. government freezing those assets for sanctions reasons, but that's no different from your bank account. So, I think it will invite more regulatory scrutiny, and the big problem I think we've seen over the years with multiple regulators around the world is that they just do not understand the technology at its core, and because of that, they make bad regulation, and that's more of a threat than anything else, I think, is bad regulation. So I'm very optimistic on countries who get this right, do it thoughtfully, and get it right, because that's where a lot of talent will flock. But we'll see. Europe is not doing a great job here. They're trying to pass all kinds of... Europe does what Europe does, which is make rules and chase all the talent out to other places. And US is a bit messy, but I think they'll get it right in the end. So we'll see. There's a lot of regulatory arbitrage going on at the same time. But of course, this invites the regulators to come and take a look in our corner.
Any, I know we're kind of out of time. Any closing words to game developers in the audience? If you were someone who was thinking of red pilling or thinking of making the switch to blockchain, and this incident might have scared you away, what would you say to game developers about your belief in the future of blockchain technology for gaming?
Do you have an inspirational quote ready, Anton?
No, I mean, I think the same thing as applies for investing. Do your own research and try to map out the risks and don't go too fast. I would like to give a lot more sort of actionable advice on this, but the fact is that the industry is still young. I mean, in a matter of sort of quite a short span of time, we've seen obviously one that we felt at the time was quite big with the attack on the Ronin bridge. But then again, dollar-wise, we're talking about tens of billions of value that was evaporated here during the Luna one. So obviously keeping in mind that it's a very nascent industry, and I don't mean to say that it's okay for this stuff to happen. I think obviously should be avoided at all costs. But when it comes to developers choosing what to build on, there's some of these have already a better kind of and more solid history behind them. So just trying to keep that in mind when doing their own research.
I'd say for anyone looking to enter, this is just a mega trend. Like, this is the opportunity of a generation to really get ahead and do something different and be innovative again. This is as big, if not bigger, than the internet itself. Get involved. It's a blue ocean. Like, come up with your own things, experiment, start companies, start protocols. It's just, you're gonna be golden for the next 20 years. This is I think the only tech opportunity in the world for the next 10 years where you really have a great opportunity to innovate, whereas the internet has become pretty siloed and stagnant. And there's multiple ways to make money, but there's also multiple ways here to make the world a much better place. And that's why some of these systems are being developed. And it's almost like little nation states, the individual networks and the philosophies behind them, right? Like, Bitcoin has a very strong type of libertarian bent. Ethereum is much more kind of liberal, inclusive type of place. And find your gang and hook into that ecosystem and build great stuff. I think you'll do very well.
All right. Well, with that, we will wrap it up. Thank you in the audience for listening. Thanks to our sponsor. And Kenrick, thank you for coming on and guesting for the first time. I hope we'll have you back again in the future.
Thanks, Ethan. Pleasure.
All right. Bye, friends.